I will be moderate. So, shall we move to the disclaimer? Yeah, this is a disclaimer from company's end. Yeah, next. This is the agenda. First, we will give the brief introduction about the company. Then Ms. Shreya will give the presentation about the quarter 4 financial statement. And after that, Q&A session will be handled by Reddy sir. Yeah, these are the guidelines regarding asking the question. You can take a print screen, and you can go through detail. Next. So, dear participant, welcome to the Q4 financial year 2025-26 earning call and investor presentation of Synergy Green Industries Limited. Synergy Green Industries Limited is one of the India's leading state-of-art foundries producing SJR, grey iron, and steel casting for wind turbines, wind gearbox, and general engineering industries in the weight range from 3 metric ton to 30 metric ton. Synergy Green has an installed capacity of 45,000 metric ton per annum and in-house machine facility of 20,000 metric ton per annum capacity. The company houses best-in-class equipment, IT infrastructure, and quality testing facilities, and is a top supplier to major wind OEMs as well as leading gearbox players in the world. SGIL is a part of Shirgaonkar Group, which has diversified business interests over its 80-plus year history spanning across sugar manufacturing, foundries, hospitality, and market research, among others. We have with us Mr. V.S. Reddy, Executive Director, Ms. Shreya Shirgaonkar, Associate Vice President, and myself, Nilesh Mankar, Company Secretary. Now, Ms. Shreya will be presenting the highlights of quarter 4 earnings and take us through the key areas of the development in the investor presentation. Over to you, Shreya.
Good evening, everyone. I'll be walking you through the key highlights of the investor presentation. So the global as well as Indian wind industry performed well in 2025. Global wind installations grew by 40%, and global wind installations stood at 164.6 gigawatts. This was mainly led by the APAC region, to name India and China specifically. India was the second largest country for wind installations in 2025. Indian wind installations in FY26 grew by 85%, and it stood at 6.34 gigawatts for the year. Going forward, by 2030, global wind installations are expected to exceed 2 terawatts, and there is still a gap, as per GVEC's report, of around 77% of required capacity for the net zero pathway outlined. There are also key drivers in the domestic wind driving growth over the next several years. Looking at the company profile, we have state-of-the-art facilities based out of Kolhapur in Maharashtra. Our foundry capacity stands at 45,000 tons per annum, and machining and surface treatment facilities that were established in the current FY stand at 20,000 tons per annum. To draw your attention to certain quality certifications that we've added in the current year, besides the ISO certifications of 9001, 14001, 18001, as well as 27001 and 50,001, we have recently been qualified for the 400 by 18 SSDI grade, in addition to the TPG certification as well. Our customers are spread across wind as well as non-wind, and we work with 6 out of the 15 leading global OEMs in the world. As of 2025, we have on our board Vestas, Siemens Gamesa, which is now Viona, Senvion Adani, Envision, GE Nordex, as well as Flender and ZF from the wind gearbox segment. Besides this, we've also added new customers in the non-wind segment. Besides Terex, Millicron, and Willow, we now have Mahindra as well as L&T on our board. FY26 was a big year of strategic transformation for the company. We've achieved several milestones in the current FY. We expanded our foundry capacity. It was a brownfield expansion, and we expanded from 30,000 to 45,000 tons per annum. We've also increased the maximum casting weight produced in the foundry up from 23 metric tons to 30 metric tons of single piece. This now enables us for production up to the 5 megawatt turbines. We also added machining and coating capacities by establishing a new plant close to our foundry of 20,000 tons per annum capacity. The commissioning and development of this plant happened within a very short span of time, including manpower onboarding, customer development, and training. In the current FY26, we've produced new product development for we've had 12 new product developments for major OEMs, including new customers as well as new products for old customers, enabling us to enhance our capacity utilization. Additionally, we also have 10 megawatts of solar captive capacity from October 2025 onboarded. FY27 presents us with a lot of opportunities as well as key priorities that need to be our focus areas. In terms of opportunities, there is a strong order book outlook, which supports our growth visibility for the year. Additionally, the INR depreciating against the USD by about 10% over the last 12 months and over the Chinese yuan by 20% has improved our export as well as domestic competitiveness. The key priorities for us in the coming year are to mitigate the input cost inflation that is arising from the West Asia geopolitical tensions, which we're seeing early signs of already in FY26. We can achieve this through manufacturing efficiencies as well as calibrated price pass-throughs. We also aim to focus on stabilization and ramp-up of our expanded foundry as well as machining capacities in order to drive utilization and operating leverage. These are some of the strategic initiatives that have laid the foundation for our future growth as well as margin expansion. Taking a look at the annual capacity utilization, FY25-26 capacity utilization at a 30,000 metric ton level stood at 93%, which is at peak levels. In the current FY, we plan to achieve about 80% of our expanded capacities utilized. Here's a summary of the audited financial results. A look at the income statement. Total income for the quarter ended 31st March 2026 stood at 123.45 crores. PBDIT stood at 14.83 crores, which translates to a 12.01% margin. Similarly, for the year ended 31st March 2026, the total income stood at 376 crores and PBDIT stood at 48.67 crores, translating to a PBDIT margin of 13.10%. The depreciation and amortization expenses for the year ended 31st March 2026 stood at 20.33 crores, as well as finance costs stood at 20.79 crores. These are mainly attributable to the CapEx program that we've set throughout the year. There are several revenue as well as profitability parameters that I would like to highlight over here. So for the revenue, certain project delays as well as operational disruptions which happened due to the brownfield expansion constrained our revenue growths. Existing facilities also operated near peak utilization prior to the commissioning of the expanded capacity. Profitability parameters included higher outsourcing costs during the relocation and facility transition, increase in manpower as well as overhead costs associated with the new facility establishment, lower export realizations due to discounted pricing, which factored in in-house machining, which is currently under development, and certain early impacts of commodity as well as energy cost inflations on account of the West Asia conflict. Looking at an overview of the balance sheet, the net worth as on 31st March 2026 stood at 111 crores. Long-term borrowings grew in line with our strategic investments throughout the year. Next. Yeah. Our revenue streams are divided across 5 segments: wind domestic, OEM exports, direct exports, gearbox, as well as non-wind. We had a 3.5% growth in revenue in the current FY26. It was mainly muted due to project delays and operational disruptions throughout the brownfield expansion. In FY27, with the expanded capacity that is coming in hand, as well as the new customer development, there is a visibility for a healthy double-digit revenue growth. We're projecting a 33% growth that takes our revenues to 500 crores in FY27. Looking at the PBDIT over the period, PBDIT margins stood at 13.1% in FY26. This is an 8% drop at an absolute level over the previous financial year. Strategic investments along with the projected revenue growth are expected to together strengthen our margin by over 300 basis points in FY27. Looking at the FY27 performance outlook, just to sum up, we've projected a revenue growth of about 33% with new customer additions as well as enhanced capacity. Our export revenues are projected to remain stable in line with the previous years, contributing around 25 to 30% of our revenue. And PBDIT margins are expected to expand by over 300 basis points year on year. With this, I close the presentation and I open the floor for Q&A.
We can move on to the, yeah. Good evening, everyone. Once again, thank you all for joining this call. I request Mr. Nitin Dharmav, sir, please go ahead with your question.
Yeah, thank you for the opportunity, sir. Am I audible?
Yes, sir. Please go ahead, sir.
Okay. So, sir, we did mention last time, I remember that next year 530, 550 crore revenue possible. So why are we now taking 500 crore revenue projection, and what is the margin guidance for financial year 27? We said that we'll have 300% upside possibility in the margin. So can you please elaborate on these 2 points?
See, there are 2 aspects. If you look at order book perspective, I see closer to 530 or 550 level actually, because we have added a lot of new customers and already confirmations are there from the majority of the OEMs actually. The second thing is whatever the expanded capacity, we see a quarter or 2, there will be a ramp up this thing because we have almost 30-40% new people added into the team, the train and other thing. That is one. The second thing is because we are starting with a totally fresh capacity. Generally, my observation is in the previous historical this thing, the first quarter and second quarter, particularly I'm talking domestic market, will be little slow in takeoff actually, But this year I see very strong this thing. So always there was an expectation from the university undercommit and overperform actually, Considering all those things, it may be between in the 500 to 530 range, but as of now we are given a guidance of 500 plus kind of the revenue guidance. Regarding the margin expansion, Shreya has already mentioned there are 2 key things for us. Like if we, instead of 500, if I do 530, probably I'll get another 100 basis point extra the margins because overheads are already covered. Then the margins directly, the higher revenues directly add to the margin actually. But at the same time, in the last 3 months, I'm talking about from the month of January, Government of India has put some restrictions on the Chinese import of the steel material, which has given an early sign of commodity prices escalation actually, Then thereafter, from the mid of February onwards, once this Iran story has started, there is almost a 20% rise in the commodity price. Of course, there is not much a challenge with the commodity because we get the compensation from the customer. But again, it comes with one quarter lag. Now, it's a difficult thing to predict how this is going to unfold in the going forward. Actually, we're a little cautious on the commodity side. If it stays at this level, it's good. Means I don't see any big thing. But if it is on the continuous rising cycle, always there will be a 1 quarter lag from that. So that there could be that small effect in that. There is a third thing, whenever inflation is on the rising side, it's not just the commodity, many other elements also goes up actually, no? So we are a little bit conscious on the input side. And the last thing is, from in the month of March, there was a dispute going on between the MSCB, Electricity Board, and the users about the banking of the facilities. Even though we added 10 megawatt, there are some changes in the policy, which this is in a legal system. The debate is going on. Due to that, there are some lapse units in the last 3-4 months, actually. No, of course, with increased capacity, we don't have that risk of solar generation units not using. But till we ramp up that capacity, there will be a little bit of this. And on the positive side, if you look at, we have a very good this thing, export revenues in current year. Particularly for Nordex also coming into the picture. Now Vestas also is there, and currency depreciating should be a very positive thing. And third thing is yuan also has appreciated, INR has depreciated a lot against the yuan actually, no. So today I don't see big pressure from the price pressure from the Chinese imports, because we're already quite competitive or even cheaper than the landed cost basis Chinese actually, no. This is the overall situation. I see it's a well-balanced guidance we are given. Yes, there is a range. We can maybe somewhere around 500 to 530, but that's the thing which we are given. On the margin side also, I have mentioned about the parameters which can influence our margin actually.
I got it. So there is a possibility of upside by 100 basis point in case we reach 530. Is that a
Yeah.
correct understanding?
You are right. Because majority of the overheads get covered at a 500 level. So that 30 will come with the gross contribution directly goes to the margins actually, no?
And for that, we are assuming that stability of the raw material prices remain, or there is a lag of 3 months in the escalation of the prices with the
You are
customer.
right. You're right. Because if this commodity remains stable and something resolution happens, there's no issue. But if it goes on continuously upward the cycle, then always we carry this lag actually, no?
So now, as you said, that first 2 quarters are a little challenging, and 15 days of this quarter has already gone out of 90 days. Not a big time, but 15 days you've seen that. So considering your previous experience of last 1 decade, how do you see this 15 days have gone so far in terms of demand, both domestic and overseas? And was there a significant margin pressure?
My observation is generally there will not be much changes in the export thing. They are very firm actually, no. The challenge only with the domestic OEMs, there will be some rescheduling or fluctuation in the schedules actually, no. And the second thing is we have also seen the execution is in the ratio of 45-55. Means first half is closer to. It's a very approximate number I can spell out. So 55% of the revenue comes from the second half, and 45% of the revenues comes from the first half of the year actually, no. And it seems as of now, whatever, of course, it's a very early period. We're just 1.5 month now. So we should be able to catch up with these numbers actually, no?
And is there any logistics challenges you have seen because of the Middle East crisis, especially with regard to the export from our side, or it is smooth for us?
You're right. You raised a valid point. See, what is happening is a lot of our customers or anybody they're taking exports. Many of the consignment got stuck in the midway actually. Now they're taking it through longer routes. Of course, fortunately, our scope is from X-Works or FCA. So we are not taking the responsibility on the logistics. There is a lot of volatility in the shipping cost and other things, including insurance and all. But that is not part of other thing. No? But as of now, we did not see any much impact on the demand because of all those things actually. No, so should be able to execute the numbers actually.
Got it. Got it. And what is the current capacity utilization? If you can give some details about that. You mentioned about last financial year, and you talked about the next financial year with the expanded capacity. What is the current capacity utilization?
See, now we are doing this month, we may do closer to 2,500 tons, which is about 30,000 tons, okay, which is almost 100% of the previous capacity. But it will take 2-3 months before we ramp up. Another thing what we have noticed in the early period is, earlier we were operating with only 2 OEMs, whether it is Vestas or Gamesa, or 4 products. But now we have developed a lot of products, 12 products, means complexity of the operations have gone up. Plus the new plant and the new people. When I put all those things in place, it takes some time for us to stabilize and synchronize with all this new scenario actually, Even though we have added a lot of OEMs, Actually, these patterns are the products which we already have. They are capable of giving a revenue of comfortably around 700-800 crores, or even go much beyond the number, actually. So we need to tackle the distribution of the schedules across the OEMs, because when you add more product, always utilization becomes a challenge because of the change in product and the variety, actually. So we're trying to manage what you call adjust according to the new the trend, and we're trying to synchronize the production with a full capacity utilization. It may take say maybe 4 months to come to 85-90% kind of the level. Actually, gradually the ramp up should happen. So we are saying second quarter should be able to gear up the good thing. And as far as the machining is concerned, we have already commissioned 5 machines, fifth machine, sixth machine, last machine, which should be happening another 2-3 weeks time. And 3-4 machines already got stabilization. We are at around 50% kind of the capacity utilization. Again, machining is also all 12 products needs to develop. We have completed another 30-40% of the product development on the machining side, because it is a long cycle. When I take up the machining of the first component, it takes anywhere between 7 to 10 days to establish the first product. Second time, it may take 4 days or 5 days. Gradually, it will taper down to optimal level. Actually, we have also seen the certain products which we are doing for last 2-3 months. It has already reached the optimal. That's a good sign. But we need to handle all these products, establish the machining, and then everything gets synchronized. Actually, it may take a quarter or plus 3 to 4 months. I expect to come to the completely synchronized level.
Since a couple of machines are already, established and reaching towards, stability of the operation. So do you see quarter one margins? Because machining was something where we were expecting, margin boost. So do you see any possibility of having some improvement in the margin with respect to the previous year for quarter one?
Yes, most probably Q2 should catch up, because first we had to set up the overhead costs. First quarter, we are mainly focusing on the product development, even though the machining is happening, but we are trying to take all the products on our board, actually. That's the first thing. So I don't see any significant thing coming on the first quarter because of the machining, because more than 50-60% of the time it's going to take for the development activities. Actually. Once that is done, Q2 should give a good progress on the margin expansion side.
Got it. And what is the further capex plan, if you can elaborate that also?
But as I mentioned, the market is very bullish, means very strong, actually. Particularly, I'm talking about the export market with someone like Nordex coming in. Even we are almost on the verge of finalizing the big contract with Vestas, which is closer to the next financial year. We have secured a contract which needs to be signed. That is between January 2027 to December 2027. Almost to 30-40% decent growth over the historical numbers, actually. And second most important thing is the domestic market. If you look at last year, it's almost 70% growth. We see even another 30-40% growth in the current financial year. I see a strong momentum in the domestic market as well. So there should be a very strong order book. Within no time, we should be able to come to a level of shortage of capacity again. Maybe we may come back to you with the further this thing. In this progress, we are looking for a land, because that is the biggest challenge. In the earlier case, we have seen it. There is some progress is happening. Let us see. This year we have a target at least to acquire the land. If we are able to do that, then next year definitely we should be able to look at adding the next phase.
Because if we are saying that we'll be, at 90% capacity utilization in this year, then we'll have a challenge of further, capacity ramp up. So that plan is something that we have to think now.
Yes, you are right. So presently, how we are looking at is first quarter and second quarter to stabilize and get the revenue going. This is one. Plus, try to next to 6 to 9 months, can we acquire the land? This is what the target we have in our mind. And once that is done, the next year, definitely we can look at the further additional this thing, depending on the overall progress of our business and also on the market side, actually.
So what is the long-term debt that we have now?
I think as of now, it is borrowed around 160 crores, 165.
Okay.
But still, there are some money has to be drawn for the balance of the machine payments and other things are there. And some repayment also closed by this year. So I expect a closing balance sheet of FY27 somewhere around 180 crores.
No, sorry, your voice
The
got
debt
stuck.
ratio of yeah.
Hello.
Yeah, no, what I'm going to say is, last year our debt is around 165 crores, closer to that number. And the current year still I have some money to be drawn, to some payments to be done for the final commissioning, other payments to the capex, whatever is going on. So considering all those things, I expect maybe 175, 180 crores by end of the year.
Oh, peak debt will be around
Peak debt,
175, 180.
yeah. And with a debt to equity ratio of closer to 1.5 or something like that, or below 1.5.
And have you considered the capacity expansion land purchase in this, or that will be extra?
We need to see, means in the current year revenue, so can we add that? Because land cannot be acquired through debt, actually, no? It has to be done through the internal accrual. Nobody funds for the land acquisition. It has to be funded through internal accrual.
Got it. No, I meant to say that considering that, because some cash flow will go, whether it is coming from debt or from internal accrual, because internal accrual otherwise would have gone to for debt repayment. So from cash flow perspective, I was saying that have you considered that also in this?
Okay, if I had to put this thing, definitely I don't see this debt number going up, even if land acquired, maybe plus minus 10 crores here and there, actually, no? So because land, we are looking at somewhere around 15, 16 acres of land, which is in our closer proximity, may cost around 25 or something like that. So maximum it may 10 crores plus minus can happen depending on the situation, actually, no?
Got it. Got it. Thank you and wishing you best, sir.
You are most welcome, sir. Thanks a lot. May I request Jiten Parma, sir, you please unmute yourself and go ahead with your question.
So, yeah, most of my questions were answered. Some questions were asked and some was there already in your answers. So, good evening again. So one of the questions I have is, any of our raw material is imported? Or everything is domestic?
Pig iron we import. This is one. Not pig iron, not 100%. There is a special grade pig iron is there. That we call it as a high purity sorrel pig iron. Generally, it is imported from Brazil or some language. And we also import the resin. These are the two major imported. If I have to figure out the import content versus the domestic procurement, it should be around 10%, 10-12% should be the import content in our raw material purchases.
Okay. So with the currency weakening, that would affect that portion of our imports. So
Yes,
how much
you are right.
pressure does it put on the is it a pass on or how does it work?
Actually, Furon resin is a pass on with majority of the clients. Means that is a directly whatever the purchase cost gets pass on. But there are a lot of other small things doesn't form of the part of the indexation. So there are two kind of pricing mechanism works. One is the what you call A class items, pig iron, CRC, and Furon resin. These three things gets indexed on a quarterly basis. But rest of the all elements gets adjusted in the annual pricing, actually, no. There may be some 50 basis point kind of here and there. But see, this year is a very transformation year for us. There are a lot of positive things because of the what you call capacity enhancement and also machining coming in, solar coming in and all. So we should be able to still achieve the margin expansion, actually, in spite of all these scenarios.
Perfect. Now, see, we are guiding for 80 to, and if we do 530 crores, maybe 85-90% capacity utilization, or at least we will, end in the last quarters with those kind of 85-90% capacity utilization. So when is it that, you already mentioned that you're already looking for land and all that, but when do we finalize, expansion plans? Because we can see the growth coming for this year, but what about next year? How we can, grow? So that is my question. In the sense that, what are we planning so that, this growth can continue? I mean, not similar, but a sustainable growth can continue.
Understand. See, we are looking at a CAGR growth percentage. That's one. The current year, if you look at 33% growth, what we have forecasted to 500 crores top line. And of course, last year, we did not have any sizable growth. So if you look at the previous year point of view, we are targeting somewhere around 15 to 20% kind of a CAGR growth. Now, coming back to your question, If current year we do around 500, I see a headroom up to another 10-15% growth for the next financial for sure. So next year growth is visible because we'll be entering with a fully stabilized plan with all established customer. We should be able to get a better revenue. And prior to completion of the next year, definitely we'd like to get some capacities for the FY28. Actually, that's how we're targeting. So we are aligning ourselves with the growth trajectory, and also we'd like to manage our debts because today what we have is like Nitinji, whatever he asked, the closing debt somewhere around 170 or 180 crores. If we have a good balance sheet next year, maybe below 100 crores, 70, 80 crores, it's a very comfortable, less than 1 for sure, debt equity ratio or 0.8 kind of thing, and we're good to move actually. No?
Okay. So generally, when you decide that, okay, now we want to go for expansion, till the time everything is put up, what is the period it takes for all that to happen? I mean, in the
Most
past, it has
probably
taken
we are looking. Understand? Yeah. Yeah, we are looking at somewhere around Q3 is a good watching number actually, no? So Q3 is aligned. I think we should be in a position to move.
Okay. No, so my
Current
question
year
is,
Q3.
let's say you in the Q3
Means
you
we'll be preparing
decide.
for where will you preparing for the next expansion cycle? Yeah, Q3 numbers should be a good point because because Q1, Q2 will be a lot of domestic market as I mentioned. That can give some kind of volatility. Means because of particularly what happens Q1 for every manufacturing industry in the country will always be slow start in the Indian business model. But Q2 due to rainy season, the installations will be little less because the project sites and others are not accessible. So Q2 domestic market generally there will not be much pressure. Q3 people start and Q4 is the peak pressure. This is how it works actually, seasonality basically.
Yeah. No, so my question was more towards that. Let's say in Q3 we decide that we want to go for expansion. So putting up the financial plan in place, whatever is required, this thing, that, and then actually for commissioning of the expansion, how much time it takes?
Sorry, you can take somewhere around 15 months kind of the timeline. So let us take an example of Q3 numbers are there and we initiate something and Q1 of FY28. Okay. You initiate, then by Q2 of FY29 should be there this capacity actually, means then this year we are already having growth. Next year we get around 15-20% growth, and the forthcoming year partially we get the growth from the new first. Like that we can see seamless growth for the upcoming years actually,
Perfect. So can we optimize our capacity and get some levers in the sense that if we do the more higher castings and all that, and can we optimize it to that that we can get some higher revenue potential from the existing facilities?
Yes, it is possible. Our observation is if we restrict the product mix, this capacity can easily be stretched by 10-15% or even 20% actually, But we are focusing on broadening our client base. If I do only with 2 clients, probably my capacity utilization will be almost 100% kind of thing. Because when I add more product variety, then my productivity is little lower actually, But again, we don't want to restrict the new coming customers just because we would like to optimize the existing facility, because they are going to create as a platform for the next unit actually, This is how we are looking at.
Perfect.
Thank you, sir. May I request Mr. Vineet Thakur to unmute yourself and go ahead with your question, please.
Hi, sir. Thank you for the opportunity. Most of my questions are already answered, but I would just like you to reiterate the same for me, that if that's all right for you. I just would like to know why is the other income so high, sir, this year and this quarter itself?
Yeah, there are 2 things. One is foreign exchange, the fluctuation. That is one. The second is, as we mentioned in the previous quarter call also, there is the part we put as a deposits, this rights issue money, what we raise, we put deposit. The deposit money interest is also into the other income. Generally, we have something called as a duty drawback that is mainly related to the associated with the top line. So when we do exports, we get some incentives. And also this thing, road tape, that is one export incentive and the duty drawback. So these are the 2 incentives goes into the other income actually,
So, sir, could you explain what is the percentage of duty travel you get back? Like if you do X amount of revenue, what percentage of duty travel you get back, and
generally we get 2% of the top line we get the duty drawback.
So of all the exports you do,
Means
2%
that
you get
export
drawback.
incentive. Yeah, 2% of the export revenue we get the export incentive.
And so I know we've spoken about CapEx a lot, but could you just give me the CapEx guidelines for next 2 years, or do we have a schedule for next 2 years? What are we estimating? And
In the existing the plant, we are almost got a peak the capex cycle. Barring today, we have invested for a 50% of the machining capacity. If you want, we can go it, but we have to prioritize whether it is a capacity addition or further go with replacing the machining outsourcing. Actually, no. So it will be decided based upon how the industry progress in the next 2-3 quarters. Based upon that, we will be deciding on the investing into the current capex. Barring some small investments into the product development, some tooling and other things, I don't see any big capex in the current the plant. As far as the new greenfield project is concerned, because now dollar is going every day here and there, there will be a good amount of import content. We need to see how the project cost is going to work out. Earlier, our estimate was standing between around 500 to 600 crores. This is what the rough estimate what we had, but we need to do this working. But presently, our priority is to whatever that we have invested, we'd like to look at. Because this is scientific in nature. Sorry. Yeah, please go ahead.
So your voice was breaking actually. I could not hear the after the project cost you mentioned.
No, the point what I'm trying to say is the earlier our estimate was closer to 500-600 crores. That is including of foundry, around 50% in-house machining, and also the captive renewables. These are the three combinations which we have worked out. But this cost needs to be reassessed based on the currency and other things. Probably this will be doing somewhere in Q2, Q3 this exercise, and we'll have a better clarity.
So, sir, have you already invested some capital in this? And if so, what would be the amount? Quantum?
So current year we have done about 250 crores for the existing facilities. That is foundry expansion and the machining and the solar actually. No, as far as the new plant is concerned, we're only planning to take up land acquisition in the current financial year. The balance of the majority of the capex is going to happen in the upcoming financial years.
And sir, would it be funded by debt or internal accruals, or it will be a mix of both?
See, this year what we have done is the current 250 crores capex is done through three combinations. One is internal accruals, second is partially with some amount we raise through the equity, and third through the debt. So we are targeting somewhere around 1:1, 1.2 kind of the distribution between the both debt and equity part of it.
Okay. So FY27, we don't have a clarity on how much capex are we going to do for this year is it a correct understanding, sir? As of right now?
See, if the way we have planned, Q3 and Q4 goes well, the way we have projected and all this thing, definitely we'll be taking up with a capex cycle for the next financial year. I'm talking FY28, not in 27. 27, as I mentioned, it's a nominal thing, only balancing and other things. If anything required, we'll be doing a small capex, but the big capex will happen in FY28 onwards.
Okay. Thank you so much, sir.
You're most welcome. May I request Mr. Amitabh Vatsa? Please unmute yourself and go ahead with your question, please.
Hi, sir. Thank you for the opportunity.
Yes,
Hi.
please. Yes, please.
So,
please go ahead.
my question is on slightly more on a macro related to the industry dynamics. Like you have onboarded Envision and you were trying to onboard Winwind, some Chinese OEMs. Vis-a-vis, you have European as well as American and in domestic OEM. So what is your preference order and what is our strategy ahead in terms of picking or choosing up some product with respect to some OEM so that we can maximize on the margin front?
There are two parts. One is my comfort with MNC OEMs is very good because their schedules are very stable and what they project that happens. There is a little challenging with respect to the domestic OEMs because there is a lot of rescheduling and other things happens. That's what we have seen, oscillations. And third part is Chinese OEMs. You know, it's also new for us. I do believe they should perform the way other MNC OEMs are there. But till date, it's not up to our expectation actually. No, one reason could be China may be having a lot of conservative approach toward the Indian supply chain because they were able to get at a lower prices from China. But in the last couple of months, I have seen the very aggressive follow One is yuan going up 14 rupees plus, which is almost a 20% appreciation from the previous this thing. I don't think now they have a choice to keep continuing with the importing of the casting from the China actually, no. So, but we need to see, wait and watch actually, no, how the Envision unfolds in the going forward. So as on date, we are operating with only one Chinese OEM, that is Envision, and the balance totally 6 major OEMs, and half of it is from MNC, half of it is from the domestic OEMs actually. No? And pricing point of view, we get better realization in the exports. One is due to incentive, and also second part is the currency, and always will have some headroom. But I would like to strike a balance between domestic and export revenues. You know, the reason is export is good, but we should not be going overboard on the exports because export is subject to many external factors, whether it is a policy, tariffs, currency, so many things happen, shipping, and all those things actually. You know, so domestic is one thing we should be holding our fort. Because that cannot be replaced. Say, for example, I have a better realization on the exports. I move everything capacity to the exports, but domestic is going to manage with someone else, right? So we lose the domestic market. So we should never lose. Means this is our thinking process. We'd like to strike a balance between domestic versus exports. Is margin is priority, but before that, protecting the market is also equally good priority actually. No.
Okay, so do you have any order book kind of scheduling with OEMs? And if you can share some light on that.
Yes, I've already mentioned. Of course, I'll not be able to share the individual OEM wise, but our revenue forecast, what we are given in the split of 45-55 is the very rough number actually. No, across the quarters you can consider actually. And these numbers, what we're committing, is order book point of view, I don't see any big problem, a 530 kind of a thing. It all depends on how we come forward and execute, and also how the domestic OEMs perform. That is the key factor for our achieving this number actually. No?
Okay, so I meant to say that order book in terms of visibility of order book for next years or so, like
you're talking FY28, FY28 you're talking?
Yeah.
No, as I mentioned in the beginning, I don't see any problem for even 700 crores kind of the order book actually. If you go and pull, I don't see that problem. My bigger problem is on the capacity side actually, no?
Okay, that's a good problem to have rather than having a order book problem.
But we can't keep the VM idle for keep waiting for him actually, no? We need to quickly come out. So for Synergy, order book is never the issue actually, no?
Okay, but do you see any alternatives they are looking out for, because there are so many PLI incentives? I mean, not literally to wind OEM, but as such, there are so many made in India push are there. So any new competition coming up, or any big companies like Reliance or Adani getting into this domain?
No. I don't think. See, it is a very small for a big player, but a big business for the smaller player. That is one. Second is entry barrier is very high. Even if any foundry starts tomorrow morning, nothing less than 3 to 5 years to come on board actually. No, one is plant establishment itself will take around 18 months. Needless to mention about the technology establishment and customer onboarding will take almost 12 months. Means 3 years is the minimum required, and capacity ramp up and all put together to come and compete with Synergy anywhere between 3 to 5 years. How I look at actually, no. So next at least 4 or 5 years should not have, even if anybody comes tomorrow morning itself.
Okay. One last question with respect to the non-wind portion of your business. So, did we have any initial success or any pipeline of non-wind business?
We got a L&T order for the what you call power plants. It was interesting thing to know that government is coming up with a 80 gigawatt of conventional power actually. This was also surprising move. So we got a super thermal this thing, So we got the order from that. It's a new order for us. And also we are in discussion with BHL. That will also likely to get finalized actually. These are the two new this thing. Only thing we are trying to debate ourselves, are we taking too many orders? This is a question internally we are debating ourselves. Problem what is happening is when I have more orders, more products, my efficiency, productivity, my concentration is getting diverted actually. Even though we see very good the value creation and other things are happening in the non-wind. So now today we are pick and choose where the high value, high volume business is there. We are not saying no. But at some point in time, it seems we need to consolidate this order intake. Actually, this is what we are debating ourselves.
So, any margin sacrifice you have to do if you go on that super thermal side?
No. It's a better than the existing this thing, that is not the issue. But the problem is we should not look at the purely margin point of view. We should also look at what you call the volumes, because wind gives 100 crores business just like that. But those kind of business will give 20 crores, 30 crores. So it doesn't add up to our big number and the top line side actually,
But the kind of client like BHEL and L&T, they have a huge pipeline at least, so to see. I mean that you can. I mean, there's also.
Yes, I know, because they are quoting that they have an order book up to 2037. Like that is the kind of numbers what they are quoting actually. So listening to these things, we have gone ahead and started booking the order. But at some point in time, it's good thing is to have 3 foundries actually. So that is a better situation. But we can't do it overnight. We need to nurture it over a period of time actually.
Okay. And if you can just last follow up on that, what piece of puzzle in the super thermal we are solving in terms of product, the piece, the component which we are making?
No, basically
In
there will be a case. Yeah, there will be a casings for this chamber actually. So they are all the big casings, 30 tons kind of the big casings. So those components we are planning to supply. Today they are all imported. There is no supplier in India, but we are trying to make it an import substitute component actually.
It's a part of turbine.
Yeah, it's a part of the turbine. It's part of the turbine.
Okay, thank you. Thank you.
Thank you. May I request Mr. Ankur Gulati to unmute yourself and go ahead.
So what is the production or sales in terms of tonnage in Q4?
Q4, I think 6,500 tons, 6,400 or 500. Just
So same as last quarter, more or less, right? I think last quarter was 6,675.
No, you opened it. 7,200. 7,200 was the last quarter. Previous was 6,500 and 6,000. Q3 6,200 and 7,200 was the last quarter.
Okay, so this quarter is 6,400 approximately.
Yes.
Which means average realization is 1,85,000 or 1,86,000. Is it correct?
No, so what is the difference? No, you should not look at it that way, because there will be something called as a work in progress and all. Generally, we get around 135, 140 is the relation what we get.
So can you give me the sales tonnage, if not the production tonnage?
Offhand, I don't have. If you write a mail, I can reply it separately, because this number I don't have the tracking immediately. Or if I have to spell out something, 120 divided by 140. 120 crores divided by 140. Actually, we are done, I think last year quarter 8,000 tons plus sales wise.
That makes sense.
Because there was a inventory carryover from the previous quarters. Means Q3, because there will always be cycles actually. What I produce today, I may not sell everything in the same quarter. Many a times this I produce for the future orders, and then it gets converted in the upcoming quarters.
That's
I think it's 8,500, 9,000 tons is the sales in the last quarter. 8,500.
Can this give me that data in the sense?
Perfect. Second, what percentage of exports is FOB basis and CIF basis, if you can spell?
No, everything is FCA basis.
So no shipment cost on you.
No. We don't take. Only domestic we take the shipment, but exports we don't take any shipment.
Perfect.
Because we're seeing a lot of volatility in the shipping cost. We don't want to take that risk.
That's fine. For 80% capacity utilization in FY27, you will have to sell roughly 36,000. So 9,000 per quarter run rate.
You're right.
Okay, fair enough. For F28, can we go to 92, 93 because new capacities will not come?
Should be possible. 90% plus kind of thing should happen.
And on your average realization of 1.2, 1.3 lakh, what kind of escalation or is it indexed to the commodity?
It's difficult to predict how a commodity cycle is going to operate, but generally we get around 140. You can take mean values actually, the relation values.
140.
Yeah, 135, 140. This is the number.
Last, I think Shreya said 300 basis point margin expansion is the target for F27. So that means 16 and a half broadly.
Yeah, you're right.
And this factors in all the machining benefits and all that we have been speaking about.
Yes, And we are also trying to see the both on the commodity cycle side, because today we are on the lag side. Because the last quarter also there was a price increase, current quarter also still it is in the increasing trend actually, assuming that this gets stabilized in this quarter or next quarter and everything get absorbed in the quarter. But if this keep on going up to the fourth quarter, then there will be a lag actually.
And F28, this let's say 16 and a half goes up slightly more because the whole impact of bit more
Right.
operating leverage should come in,
Right.
right? Another
You're
50
correct.
100 basis points.
See, that's how we are given a guidance of 18% plus in our original the plan. I think we are in line with that guidance.
Okay, all right, thanks. All the best.
You're most welcome. I think I've covered all the questions. If anyone has got a question, so please raise your hand. Nilesh, I think we have covered. So you can
Yes.
go ahead with the conclusion. Yeah.
Sorry,
So thank you for joining.
Thank you again once again for joining. Yeah, I think this will conclude.
Sure.
Thanks, sir. Yeah.
Just checking. I mean, given that we're let's say 6 months behind schedules to some extent, the next phase of capex is now F28 end, right? Which means any fundraise is also now F28 or F28 mid, not F27. Any equity fundraise.
See, between mid of means fag end of the F27 or early F28, we are looking at somewhere the Q4 of F27 or Q1, Q2 of F28.
And this quarter, Q4, the manpower cost bump is, let's say, I think 11 crore. Is that a steady state run rate now?
Yes, somewhere closer to, but this is the full manpower cost at the peak capacity actually, maybe means it has gone to the majority of the level. Yeah, it's already there.
And other expenses used to be, let's say, 36 crore run rate, gone up to 47, 48. So why this 1/3 jump in quarter on quarter?
No, other expenses. There will be a machining outsourcing cost because when your revenue goes up by 30-40%, the other expenses consider the outsourcing cost. So that is also built into that other expenses.
So this quarter, 48 crores on 6.
You should compare as a proportion, as a percentage of thing than looking at absolute numbers. With respect to the sales, you should compare the splits.
Understood. Oh, okay. Then it's 48. That's okay. All right. Thanks.
Thank you. Yes, Nilesh. Yeah, you can go ahead and conclude.
So thanks everyone for sparing your time and joining today's meeting. On behalf of entire Synergies team, I conclude this meeting has been over. I say that this meeting has been over, and I wish all the best for your investing. Thank you once again.
Thank you all.